Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to this final special edition of our Standard Chartered Money Insights mini-series, covering different topics relating to our 2022 investment outlook. My name is Steve Brice, the bank's Chief Investment Officer, and I'm delighted to have with me Trang Nguyen, who looks after our foundational asset allocation models for the CIO office. Today, we're focused on income investing. Obviously, income investing has become harder since the global financial crisis of 2008-2009, as bond yields have collapsed. So Trang's insights hopefully will guide us how to generate sustainable income going forward. Okay, so enough of the introduction. Trang, I suppose for multi-asset income, it is still pretty hard to find yield, especially after taking inflation into account. What is the best strategy for income investors in 2022?
Thank you, Steve. Now, despite improved modestly in 2021, global bond yield remain low. So the best strategies for income investor to achieve their yield target, and more importantly, to be able to sustain that yield, is diversifying the source of income. And by that I mean not only diversifying the source of yield within traditional bonds, but also across different asset classes that can offer income. And I would like to spend a couple of minutes here to explain that. Now, within bonds in 2022, we believe that income investors should still hold a large exposure to high-yield bonds, such as developed market high-yield bonds, but at the same time, for similar exposure, investor can consider some allocation to global floating rate notes. Now, we like this asset because they provide similar level of income as other developed market high-yield bonds, but with much lower interest rate sensitivity. So historically, we have seen that global floating rate notes have been more resilient in the environment of rising interest rate compared to other fixed income. Now, fundamentally, we are constructive on this asset because default rate is expected to stay low. Recovery rate should be in line with historical average. Supply and demand picture looks supportive. Now, another way to diversify the source of income within credit is to consider having some exposure to subordinated financials, such as contingent convertibles and preferred securities. They have attractive yields, and these assets have great exposure to financial sector, so they tend to do well in the environment of rising rates. Now, though fixed income assets have been and will continue to account for a large part of any income portfolio, we would encourage investors to look beyond the traditional bonds and find opportunities in global dividend equities and hybrid assets such as real estate investment trust. Now, these assets can provide comparable yield, and at the same time, they allow investors to enjoy potential gain in price return. And this is the case because in 2022, we expect global growth expectation to remain supported. And within dividend equities, we also see opportunities in Europe, which currently offer yields about more than 5%. So those are a couple of areas that we think income investor can focus on in 2022.
Thanks, Trang. That's pretty comprehensive. But I suppose the one of the concerns investors have today is around inflation. So now we obviously expect inflation to head lower as we go through next year, especially into the second half. But how do people factor in, or what does the inflation risk mean for income investors as we head into next year?
Now, you're right, Steve. However, in my opinion, it's always more appropriate to evaluate the impact of inflation in the context of growth as well. So that is why in our publication, we have looked at different scenarios of growth and inflation to provide more detailed guidance for income investor for the year ahead. Now, that being said, to put it very simple, one key observation on inflation from our historical analysis is that higher inflation tend to mean higher probability for tightening policy from the central banks, and that can translate into higher interest rate and rising bond yield. Now, for income investor, it can mean higher income potential, which is good news. But the risk here is that some assets might suffer from lower price return because inflation tends to weigh on capital appreciation. So you're right, in 2022, we expect inflation to slow down in the second half of the year and global growth to remain strong. So we remain comfortable with the strategy to reduce the overall traditional bond allocation to fund exposure to dividend equities and non-core income assets like covered call strategies, subordinated financial, because as discussed earlier, these assets should be able to help us improve the yield potential as well as generate positive total returns.
Okay, thanks, Trang. That is all we have for today's special edition of Standard Chartered Money Insights. If you would like to learn more or read our publications, please visit our website at sc.com under Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcasts. Thank you for joining us. Enjoy the rest of your day and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.